Welcome to the Deep Dive, your shortcut to being well informed. Today we're getting into the weeds of the Office for Budget Responsibilities. That's the OBR's latest economic and fiscal outlook.
Yep, the EFO from November 2025. And this isn't just a simple forecast.
No, it's really the official map of the UK's finances for the next 5 years, right up to 2030-31. It includes all the new policies from the autumn budget.
And, well, if it's a map, it's showing a journey that's almost entirely uphill.
Yeah.
The OBR is forecasting, a bit of short-term fiscal easing, some giveaways, but then a really dramatic long-term tightening.
So our mission today is to figure out how that works.
Exactly. We need to peel back the layers and really understand the drivers. Specifically, how on earth the UK is planning to get to an all-time high tax burden and what that actually buys the government in terms of hitting its targets.
And if you want the one number that just jumps off the page, it's this. National accounts taxes as a share of GDP are forecast to hit just over 38% from 2029-30.
Which is huge.
It's 5 percentage points higher than before the pandemic. I mean, that's a massive structural change in how much tax the UK economy has to bear.
It's absolutely historic.
Right.
And you can't understand that number without looking at the immense international pressure the UK is under.
Right, the cost of borrowing. It all comes back to that.
It really does. I mean,
Yeah.
We are in a very, very pressurized position right now.
How bad is it, though? We know rates are high everywhere, but where does the UK actually sit?
Well, we're leading the G7, but not in a good way. UK government bond yields are the highest in the entire group
The highest in the G7.
and the second highest among all advanced economies. Only Iceland is paying more to borrow right now.
Wow. So the market is essentially charging the UK a premium.
Right.
What's behind that? Why are investors so much more nervous about our debt compared to, say, Germany's?
The OBR points to three things, really. First is inflation. It's just expected to be higher here for longer. They're forecasting an average of 3.5% for the UK in 2025, while the advanced economy average is more like 2.6%.
So investors want a higher return to cover that. Makes sense. What's the second factor?
It's the sheer amount of debt we've taken on. Since 2019, our government debt has jumped by 18 percentage points of GDP.
18.
18. The average for other advanced economies was just a 3-point rise.
18 versus 3. That gap alone tells you a lot about the market's anxiety.
It really does. And the third factor is a bit more subtle, but it's so important for, how fragile the situation is.
Go on.
It's the big drop in domestic demand for our own government bonds, for gilts.
So UK institutions are buying less of UK debt.
Precisely. You've got fewer of those big defined benefit pension schemes, which were always stable long-term holders. And at the same time, the Bank of England has flipped from buying bonds to selling them.
Right, from quantitative easing to tightening.
So that guaranteed buyer of last resort is gone. This means we're much more reliant on overseas investors who are, frankly, much more sensitive to pricing confidence.
It makes our whole borrowing position feel a lot more brittle then.
That's the perfect word for it, brittle. And that explains the premium we're having to pay.
Okay, so that's the very expensive foundation. Let's look at the near-term forecast itself. What's the OBR expecting for, the average person's experience of the economy compared to the last forecast in March?
Well, the outlook is definitely higher for longer. CPI inflation isn't expected to get back to the 2% target until 2027 now.
A whole year later than they thought in March?
A full year later. And the average inflation for 2025 and 2026 is revised up to 3%.
And what about wages? Is pay keeping up with this stickier inflation?
Nominal earnings growth is also running hotter. It's forecast to stay at around 5% in 2025 before it slows down. But even that is about 1 percentage point higher than the March forecast.
So, on paper, more money is coming into paychecks. But that's the nominal figure. It doesn't really tell us about the real health of the economy, does it?
No, absolutely not. And this is the fundamental problem. The big underlying challenge is that trend productivity growth has been downgraded again. It's been revised down from 1.1% to just 0.8% by the end of the forecast. So if output per hour is barely growing, that high wage growth is just fueling inflation. It's not real sustainable growth.
Which brings us neatly to the government's entire strategy. If you've got high borrowing costs and low productivity, you're cornered. And their plan is almost all about tax.
Overwhelmingly so. You look at the public sector net borrowing, the deficit. The plan is to get it from 4.5% of GDP next year down to 1.9% by 2030-31.
Okay, a big fall.
A huge fall. And here's the key bit. Almost all of that reduction comes from one place, a 1.7% of GDP increase in tax receipts.
So this is, at its heart, a tax-raising plan. And the main engine for that is this thing we hear about all the time, fiscal drag.
It is. And it's so powerful because it's almost invisible. The key policy is just extending the freeze on personal tax thresholds.
For income tax and national insurance.
Exactly. They're not announcing a new tax rate. They're just freezing the income level where the current rates start to apply.
And with that 5% nominal wage growth we just talked about, more and more people's pay rises are pushing them over those frozen thresholds.
That's it. Inflation gives you a pay rise in cash terms, but the Treasury immediately claws a bigger slice of it back because the goalposts haven't moved.
And the numbers are huge, aren't they?
Just staggering. This measure alone, freezing the thresholds, is forecast to bring in an extra £15 billion by 2029-30. It's a tax hike in all but name.
But there's another part of this that's just as important. You mentioned the composition of economic growth is helping the Treasury. What does that mean for growth to be fiscally favorable?
Means the bits of the economy that are growing are the bits the government taxes the most.
Right.
So labor income people's wages and salaries is very tax-rich. It has an effective tax rate of about 40% when you combine income tax and NICs.
Okay, and how does that compare to something like, say, business profits?
Well, corporate profits have a much lower effective rate, around 17%. So the forecast is for growth to shift towards that highly taxed labor income and consumption and away from business investment.
So even if the whole economy grows a bit slower than hoped, the government's share of that pie gets bigger because the growth is happening in the right places for them.
You've got it. The composition of the growth is doing a lot of the work for them, helping them hit their borrowing targets.
Which is a huge structural advantage. But this record tax take wasn't just about paying down debt. It also had to pay for some pretty significant new spending commitments, didn't it?
That's right. They've actually reversed some previous welfare cuts, and those reversals are expensive. We're talking about an extra £6.9 billion a year in spending by 2029-30.
So what were the big-ticket items there?
Two main ones. First, they scrapped the plan to tighten the eligibility criteria for the Personal Independence Payment, or PIP.
And the cost of that?
That alone cost £3.9 billion by the end of the forecast. A very significant decision. The second one was removing the two-child limit within universal credit.
A policy that's been in place for a long time.
It has. And removing it costs £3 billion by 2029-30. The estimate is that it will benefit over 500,000 families.
So even with all the pressure to tighten the books, they've made these specific choices to increase spending.
They have, which, makes that need for tax revenue even more acute.
Let's stick with tax, but look longer term. We always talk about the black hole that's coming from fuel duty as we all switch to electric cars. Did they do anything to address that?
They did, finally. They've introduced a mileage-based charge on electric cars starting in April 2028.
A pay-per-mile system.
Essentially, yes. It's an attempt to plug that future gap. The rate is set at about half of what you'd pay in equivalent fuel duty. So 3 pence per mile for a battery electric vehicle.
It's a necessary step, I suppose. But does it actually solve the problem? Is it enough?
Not even close, unfortunately. The OBR's analysis is pretty stark on this. They project this new charge will only make up for about a quarter of the lost fuel duty revenue by 2050.
Only a quarter, so it leaves a 75% hole in the finances.
A huge unresolved problem for a future government. And there was a fascinating detail in the report about the immediate impact of this charge.
Oh yes, the correction slip, what did that say?
It estimates that introducing this charge will lead to around 440,000 fewer electric car sales over the forecast period than would have otherwise happened.
Wow, so trying to secure future tax revenue actually slows down the green transition, even if only slightly.
It's a perfect example of a policy tightrope, isn't it?
It really is. And speaking of fuel duty, we have to mention the what seems to be the permanent temporary freeze.
Ah, yes. The 16th consecutive postponement, the 5-month freeze in this budget, is just the latest in a very, very long line.
16 times. What has the cumulative cost of that one political decision been since 2010?
It is an eye-watering number.
Yeah.
The total cost of all the fuel duty freezes has now hit £120 billion.
120 billion. That's just a phenomenal amount of lost revenue.
It is. It shows just how politically toxic it is to raise taxes directly and why they rely so heavily on hidden measures like fiscal drag instead.
Okay, before we get to the final verdict on the targets, was there any good news? Any potential upside mentioned?
Well, there was a brief mention of the India-UK Free Trade Agreement. The government estimates that could add about 0.13% to real GDP
By when?
by 2040. So it's a welcome bit of good news, but it's not exactly a game changer for this five-year forecast.
Right. So let's get to the bottom line. After all this, the high borrowing costs, the historic reliance on fiscal drag, the spending reversals, did the government actually meet its main fiscal targets?
Yes, it did. The primary mandate, which is to balance the current budget by 2029-30, is forecast to be met. And not just met, but met with a pretty big margin.
How big?
£24 billion. That's 0.7% of GDP.
24 billion. That's double the headroom they had back in the March forecast. That feels like a big political win.
It is. The probability of meeting it is now up to 59%, which is the highest it's been since before the pandemic. It gives the chancellor a lot of breathing room.
What about the other targets?
The welfare cap is also met, but only just. The margin there is a very slim $1.9 billion, so welfare spending is still on a very tight leash.
So even with a 24 billion buffer on the main target and this record tax take, what's actually happening to the UK's national debt? Is it falling?
No, that's the crucial thing. Despite everything, public sector net debt is still forecast to keep rising. It's set to reach 95.3% of GDP by 2029-30.
Which is still incredibly high by historical and international standards.
Incredibly high. It's about twice the advanced economy average. That leaves our public finances incredibly vulnerable to any kind of shock.
And what are the specific risks the OBR flagged? What could knock this whole plan off course?
The biggest one goes right back to the heart of their strategy. It's sensitivity to nominal earnings growth.
Because the whole fiscal drag plan depends on it.
It's the cornerstone,
Right.
and the numbers are frightening. If average earnings growth turns out to be just 1.8% lower than they forecast, tax revenues would fall by £19 billion.
19 billion. So that would wipe out almost the entire 24 billion margin in one go.
The whole thing collapses. The strategy is incredibly brittle. If inflation falls faster than expected, or if the economy slows and wage growth stalls, the main revenue engine just stops working.
So to pull this all together, this deep dive shows the government has, on paper, met its targets. It secured a much bigger buffer than anyone expected.
That's the headline, yes. But the way it's been achieved is by locking in this unprecedented tax burden almost entirely through the stealth mechanism of fiscal drag.
A mechanism that relies on continued high inflation and nominal wage growth to function.
And what's really striking, I think, is the sheer effort required just to stand still. The OBR says that from 2028-29, the UK needs to run a primary budget surplus.
So tax revenues have to be higher than all non-interest spending.
Just to stop that huge pile of debt from growing any further. We're running as fast as we can just to stay in the same place.
And that uphill battle really frames the final question for you, the listener, to think about. The entire success of this fiscal plan rests on making a temporary policy, these frozen tax thresholds, a permanent feature of our economy. Given how sensitive that is to wage growth, how vulnerable we are to global shocks, is that kind of reliance on fiscal drag a truly sustainable economic strategy for the long term? We'll leave that thought with you. Thanks for joining us for the deep dive.